Have you ever been confused by the term MLTA and MRTA when you're getting a home mortgage for yourself? Well, in this video, I'm going to walk you through the differences, pros and cons of the MLTA and MRTA. Welcome guys to my channel. My name is Chanel Chong. I share videos on insurance updates and financial knowledge every single week. So if you're interested in these kind of topics, don't forget to subscribe to my channel, hit the bell button so that you get notified on all my future videos. On 8 July 2020, Bank Negara had announced that it had further cut down the OPR to the lowest level ever at 1.75%, which means that borrowers can now enjoy the lowest rate ever for the housing loans, which can go as low as 3% to 3.5%. It is a good news to all Malaysians. Well, I still remember my mother telling me that when the market was booming 20 years back, she used to borrow money from bank at the rate of 9.5 to 9.75%. So can you believe that the interest rates has gone down so much during this year during the crisis? It is definitely the best time for all of us to buy a property now, given that the market price for the properties are going down drastically during the crisis. And banks are also offering the lowest interest rates ever, which means cheapest installments ever. But wait a moment. What about the protection insurance to protect your home? When we are purchasing a house today, we are also obtaining a huge amount of loan for us. That's why it is very strongly recommended that we should get a mortgage insurance to protect ourselves and our family in case of death or TPD. Having a mortgage assurance policy will give you the peace of mind just in case of any misfortunate events that is going to happen to you. This is extremely important if your family is still staying in the house which is currently still under financing. Not only that the mortgage assurance policy can make sure that they can still continue to stay on, it can also make sure that whatever burdens is being settled off upon any misfortunate events. Otherwise, without this mortgage insurance, if the family member is unable to pay off the debts, the bank has the right to gain ownership of the house and auction it off so that whatever amount that they get can be used to pay off the debts. You definitely don't want your family to face with that kind of stress when you're gone. So definitely it is very important for you to plan out the mortgage insurance when you're purchasing a new house. So there are two types of mortgage insurance in the market, namely MLTA and also MRTA. So what is MRTA? MRTA is Mortgage Reducing Term Assurance, which is a kind of life insurance plan with a decreasing sum assured over the time. It is being used to pay off your outstanding home loan in the event of death or permanent disability. MRTA is usually being offered by the lender, in this case, banks. As the name mentioned on the reducing, it has the reducing coverage, which means that the protection on the loan will decrease as the loan decreases. It doesn't come with any cashback, which means that whatever amount that you're paying to the bank is only for the exchange of the protection. There will be no nomination in the case because the beneficiary will be the bank. So whenever the payout is going to happen, the payout is only to the bank to pay off whatever debts that you owe to them. MRTA is non-transferable, which means that it got to be tied up to your loan on the same property. MRTA is being calculated on a lump sum basis. For example, if the lump sum amount of MRTA for your property is 20,000, you need to pay the whole lump sum to the bank. But you are also given the option to finance it into your loan. But bear in mind that whatever amount that you're going to finance for your MRTA may end up to be doubled along the way following the interest rates, which eventually may total up to 40,000 in the 35 years tenure of your loan. MRTA does come with a few pros, first being that it is much more affordable compared to MLTA. Secondly, the bank will be able to give you lower interest rates if you take up the MRTA plan from the same bank. So the cons of MRTA is that if the MRTA is being included into the loan, home borrower will need to bear in mind that whatever amount that they're paying now will go up double by the end of the tenure. So for example, if the MRTA is 20,000 now, you may end up paying 40,000 in the long run. Cons number 2, it is possible that the MRTA coverage may not be sufficient to pay off your loan. Now, the MRTA coverage is being calculated based on the current interest rates. If the current interest rates were to go up in the future, it is possible that whatever payout from the MRTA is not being able to suffice the loan that you're owing, which means that the family member will need to top up the differences to pay off the bank. MLTA is known as Mortgage Level Term Assurance. Now, similar to MRTA, MLTA is also used for the home protection. Unlike MRTA, it is not being offered by bank, instead it is being offered by the insurance company. Like the name mentions, it comes with a level coverage, which means that the protection is level till the end of the tenure, and it will not be affected by any loan interest fluctuations in the future. Contributions into MLTA also comes with a kind of cash value upon maturity. And the best news is, the ultimate beneficiary of MLTA payout is going to be your family members, which means that whatever that you got yourself covered will be the full amount that your family member is going to get. For example, if you got yourself covered with a 500,000 coverage, and if the loan outstanding at the point of death was 300,000, 300,000 will be used to pay off the debt, and your family member will be able to still enjoy the payout of 200,000 ringgit for their future living expenses. MLTA is transferable, which means that it can help to protect a few loans at the same time, as long as the total loan don't exceed the protection that you're being covered. Policyholders of MLTA can also enjoy different payment modes instead of a lump sum payment. Pro number 1 of MLTA is that there will be no interest being imposed on the insurance premium. The price is being determined upon the purchase of the plan. Pro number 2, nomination can be done to protect your family. So it is very suitable for a long-term financial planning, especially if you are supporting your family financially. So it is better for you to subscribe to a MLTA policy due to the high payout of insurance. As mentioned earlier, MLTA can be easily transferred, so it is an ideal plan if you're making multiple investments. Now, given the multiple benefits being offered by MLTA, the cons of MLTA is that the pricing point for MLTA is usually higher as compared to MRTA plans. Last but not least, always spend some time to understand the key features of MLTA and MRTA when you're buying a house. And if you have any doubts, sit down with your insurance advisor or your banker to discuss with them to understand more about it. Now, bear in mind that this planning is a planning that is going to affect you for the next 30 to 35 years, so you definitely want to give it a deep consideration before you enter into one. Hey guys, if you like my video today, don't forget to give me a thumbs up and leave your comment down below. I'll see you again in my next video. Bye!